welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, it has been an amazing week when it comes to commodities. You saw the supply concerns remain when it came to crude oil prices. And since we've started 2017, this is a second straight week of decline coming in for the crude oil prices. While you have seen the China import numbers strong, the expectation also is that the Saudi Arabia and Russia, the two major producers, will continue to cut production. But on the other supply, it is the oversupply concerns and the higher global inventory which continues to weigh on those prices. But it has continued well for the precious metal space, where you have the gold prices at a 7-week highs and silver as well trading at a 5-week highs. We are closing this week nearly 2% up for both of these. But the best performance, of course, comes in for the base metal space, where you have the steel prices 8.5% up in this week, and that's because China is cutting its supply output or overcapacity in case of steel, and that has been supportive. It has been a good week also for copper, nickel, zinc. All of these metals are trading nearly 4 to 7% on the higher side on expectations of strong China data, strong import numbers, infra spending from China and other part of the world, and that's taken the prices higher. In the currency space as well, after the Trump press conference, we have seen the dollar index decline. That one is down nearly 1% in this week. But the high-risk Asian currencies and the EM currencies, all of them are closing this week on the positive side. But Commodity Outlook 2017, well, that is something everybody is keeping an eye on. And to get you an outlook, we have with us Edward Morse, who's Global Head Commodities Citi, and he joins us with his strategies for the year ahead. Edward, hi, good to have you. Well, what is the sense from the OPEC deal? Because this is the year we have seen official cuts now start. Saudi cuts are at a 2-year lows, and that definitely should have been a positive. But what is your sense on the members who are not cutting? Because we've also seen a ramp up in production come in, especially from producers like Canada and US.
I think there's an optical illusion in what you're saying. To be sure, the bulk of OPEC countries, and particularly the main ones, have cut production. That's true of the big guys, Saudi Arabia, Kuwait, the UAE. It's true of Russia. The evidence is very clear that Russian production is down as well. The noise in the system is really coming from two Middle East countries. They're coming from Iran and Iraq. And I think it's more noise than anything tangible. On the Iranian side, it's mostly coming quite clearly out of inventory that was floating, is now being cut. There's no evidence of any growth of any significance in Iranian production, nor do we expect there to be over the course of the year. So we think that'll settle itself out. And similarly, Iraq has more loadings out of Basra than were expected. But that's following a period of time in which the loadings were low. So to be clear about the OPEC agreement with non-OPEC countries, it's not an agreement to be assessed on a month-by-month basis, although clearly watching what happens by month is important, but rather it's an agreement such that through this 6-month period of time that started on January 1, average production will be going down by the stated amount according to the target for that 6-month period of time. For some countries, that's going to be bulked up. It's going to be concentrated in the latter 3 months of this 6-month period of time. The really clear evidence of the big production going down is from Russia and the main GCC countries. And I think that's what the market will be focusing on as inventory data come into the system later on in February and March.
Well, yes, it's a wait-and-watch mode on that one, Edward. But what is your sense on the price outlook? Because we have this varying range between 45 to 65. What is your sense for this quarter, the rest of this year?
Well, I think the range is going to be bumpy, so we're always mindful of the bump, and indeed our projected price for the first quarter is $50 a barrel Brent. Brent has been averaging higher than that so far in the first quarter. Our $50 number clearly expects that there's going to be a bumpy ride ahead. Just looking at loadings and contrasting that with deliveries. So deliveries coming into China, South Asia, or into North America are deliveries from crude oil that was lifted as far back as November. It's not going to be until March that we see a very clear sign that the cutback starting in January is impacting delivered crude in a delivered market. So we've got to expect this noise as a kind of reasonable factor in the market, but there's no doubt from the loadings perspective that loadings are going down, and we expect the market to continue to balance and tighten up with an inventory draw every single quarter of 2017.
Edward, let's shift focus now to the precious metal space, and the gold prices as well have started 2017 on a positive note. What's your sense? Will we continue, or will we be able to hold these gains ahead?
Actually, when we look at the PGM group, we would actually select palladium and platinum well above either silver or gold. And that's because they're responding to not a monetary or financial market, but to a real supply and demand market. And we think catalyst demand is going to rise. We're just coming off a period in which we've seen spikes in prices of oil and platinum, palladium, and copper. And we think we'll see those again as the market really does tighten up for those commodities, but not so much on the gold and silver side, because they have been, on the gold side, more reflective of monetary and financial conditions, and on the silver side, as kind of the retail outlet for the institutional outlet for gold.
Edward, 2016 was all about positive money coming back in case of commodities. When it comes to 2017, what is your best bet when it comes into this sector? Would you rather go for metals, or is it going to be precious metals, or as you said, it's going to be a bumpy ride for crude?
Yeah, we see the run continuing with one big exception, and that is the bulk commodities, so iron ore, thermal coal, coking coal, saw spectacular jumps of 100 to 200, 300% in terms of prompt prices. We don't think that had anything to do with fundamentals. They were outperforming commodities through 2016. Now they're coming off finally again. We think the performance of the bulk commodities was related to speculation on Chinese exchanges, related to dysfunctionality in the management of the Chinese economy, which fed into that speculation. But the underlying phenomenon in the supply-demand basis for the bulk commodities is bearish. So we think we'll see the prices of them coming off. We think wheat and soybeans are not going to go anywhere. But for the metals, we think what we saw in 2016 will grow even more so in 2017, and the same thing with oil and natural gas. We're looking at Brent printing a $65 average price in the fourth quarter, which means periods of time in which it'll be trading above $70. We have a great confidence in that forecast for not just oil, but for copper and nickel and zinc. And honestly, the fundamentals really look much stronger than they have at any point since 2011 and the time of the MENA spring.
Edward, you clearly have a very bullish call continuing for the metal space, but as you also pointed out that the China demand would be an important thing to watch out for. The US has been talking about infra spending also. So between China and US, where do you see the major cues coming from?
Yes, we certainly do see Chinese demand going up. In general, it's going up because China's become an intermediation center, a processing world, importing more commodities, processing them, and exporting. So this is true in oil, importing more, having huge capacity to refine and exporting refined product. But the same is true in copper. The same is true in iron ore with the transformation into steel. So we think aside from that process, the new 5-year plans are fairly impressively concentrated on fixed asset investment of a sort that's going to see copper demand growing not just from the perspective of white goods and automobile sales, but for the transformational rebuilding of both the transmission grid and the distribution of electricity, which is incredibly copper intensive. So we think copper imports will grow above the levels they were, and that was pretty healthy growth in 2016, and the same for most other industrial metals.
Your point is well taken, Edward. We'll let you go at that. So that's a view coming in from City really. Very bullish, continuing in case of commodities. And in this sector as well, metals is what stands out. And copper and zinc are their favorites when it comes to this space. But with that, it's time for a quick break. But up next, we speak to Mr. S.K. Goyal, who's former Principal Secretary, Government of Maharashtra, on what lies ahead for the agriculture sector.